What's better, a 15-year mortgage or a 30-year mortgage? Well, in this video, I'm going to show you a side-by-side comparison with our TCA or our total cost analysis so you can decide for yourself what's the better mortgage for you. So let's hop into the video. In today's video, we're going to be comparing a 30-year mortgage and a 15-year mortgage. More often than not, you're going to get a 30-year, but a lot of people are unaware of other options that are out there to finance a home. And in today's video, I want to compare a 15-year mortgage and a 30-year, and then we can decide what's going to be the better route for you. What we're going to hop into right now is our TCA, or our total cost analysis. We go over this with every single client that we have because we want to bring the transparency to the mortgage business so you guys as consumers get a good idea of how all the numbers work out. Because so often we get distracted by just what the lowest interest rate is, and we don't really go into all the costs and details of what and how a loan's structured. So I want to show you folks what a 30-year looks like versus a 15. So let's hop into the analysis. All right, so on our analysis here, we are simply comparing a 30-year mortgage and a 15-year mortgage. You can see here are two 30-year columns that we're going to be running through really quick. This is based on a $400,000 purchase, assuming a 720 credit score, putting 20% down. Now I know some of you may not have the 720 credit score or maybe putting 20% down, but this is just a general rough idea of how the loan would shake out. Again, if you guys have specific scenarios, make sure you send us an email so we can give you an example like this to help you make your decision as to what loan option is best suited for you. Because no two loans are alike. A 30-year option may not work for some people because maybe you're looking to retire or you want to pay your house off faster. But let's jump into the numbers. On a 30-year fixed mortgage today, if you're putting 20% down, your interest rate at a par rate, which is about 3.625, meaning you're not paying any points or nothing to buy your interest rate down, that would get a total payment, including your taxes and insurance, about $1,759 a month. Okay? Now, the other option is you can pay points or buy your interest rate down. Now, many times when you're shopping online and you're looking at some of these online lenders that are advertising interest rates, they actually are advertising rates with points. And a lot of times they're even showing you multiple points to buy the rate down. Now, a point is essentially 1% of the loan amount. So you can see the closing cost here is increased by $3,200 roughly. That meaning you're paying one additional point to buy your interest rate down and get a lower rate. So this is going to cost this specific buyer an extra $3,200 to go from 3.625 to 3.375. Now that yields them a savings of about $45 a month. And now the thing to consider when you look at determining whether or not it's worth it to pay the points and buy your rate down is you take a simple break-even analysis. So it's going to cost us $3,200 to go from 3.6 to 3.375. Again, that's a $45 a month savings. And if you look at your break-even, you're going to look at 71 months. Now, if you decide to sell or refinance your house within 71 months, it would not make sense to pay the points. However, if you plan on living in the home for longer than 71 months, you don't touch your mortgage, you definitely want to go ahead, pay the point, buy the interest rate down to 3.375. So now we're going to hop into the 15-year. Again, same columns, same example. $400,000 sales price, $320,000 loan amount, 20% down. And on a 15-year, the par rate today is 2.75%. compared to the 30-year at 3.625. And typically on a shorter term loan, you have a lower interest rate as well. So on the 15-year, we're at 2.75, gives us a total monthly payment, including taxes and insurance, about $24.71 a month. Compare that to the 30-year mortgage. You're looking at a difference of a little over $700 a month in payment. Now, let's look at the option of paying points and buying the interest rate down. Same example, $400,000 sales price, 20% down. Again, the 1% is based off the loan amount. So an additional $3,200 gets our interest rate down to 2.5%. yielding a monthly payment, including taxes and insurance, of $24.33 a month. You can see in this example on a 15-year mortgage, buying a point or 1% of the loan amount only saves us $38 a month. So we can run the numbers again and see where our break even is. $3,200 divided by our $38 a month savings takes us out to 84 months. So if you are looking to pay a point, remember, are you gonna stay in the home for longer than 84 months? If you're gonna sell or refi within that time frame, I wouldn't suggest paying the points because you're gonna take on an additional $3,200 in closing costs just to save $38 a month in monthly payment. This is why it's so important to run the numbers, because when you're shopping online and all you're doing is chasing what the best interest rate is, you're not looking at all the details and the comparison between paying points versus not paying points. In this scenario on the 15-year, what if you were to go and pay the extra points, pay an extra $3,000 or whatever your loan amount ends up being? Could be less, could be more. And you can see in that specific example, we're saving 38 bucks a month. You're not even gonna tell what the difference is in terms of your monthly payment, but that lender could have charged you an extra several $1,000s just to close, but you could have actually saved yourself some money, taking a slightly higher interest rate and being able to close on your property. So this is why I stress so much the importance of looking at your options. And if you're working with a lender that does not give you an analysis like this, and they're just rattling off numbers to you or sending you an email with a breakdown or using an Excel spreadsheet, I highly suggest you shop around and get with someone who has software like this that you can see a clear example of how all the numbers work out. Because you can now see between our 30-year option and our 15-year option, the difference in the interest rates, the difference in cost, and how much of a savings does that truly mean to you as a home buyer at the end of the day. Now, the one thing I will point out, the advantage to a 15-year is obviously you pay your house off faster. So maybe this is geared towards someone towards the tail end of their career and they just want to be debt-free. And maybe they know that, hey, I've got another 15 years that I'm going to be working and my house needs to be paid off. That's definitely an option that you want to look at, because as we scroll into our column here and we can look at the interest paid in 15 years, obviously if you're paying your house off in half the time, you're paying about less than half the interest. Now the difference between the 15-year and the 30-year is a little over $70,000 worth of interest that's paid. Now the thing to consider is whether or not you want to pay points, because paying points on a 30-year loan, you would then save yourself about $11,000 worth of interest in the first 15 years of your mortgage. On a 15-year mortgage, you're saving yourself about $7,000 worth of interest. Again, the trade-off is paying that additional point up front, that additional $3,200, but it saves you over the life of the loan. Another option that I've talked to our clients about is taking a 30-year mortgage, but maybe we calculate what a 15-year or a 20-year mortgage payment would be, because now you have the flexibility to make those extra additional principal payments. The downside to that is you have to be disciplined enough to make those payments. But the upside to that is, let's just say you're in a commission job and you know some months it's tougher than others, right? So in this scenario, the difference between a 15-year and a 30-year, you're looking at over $700 a month in payment. And sometimes if you have a slow month, that extra $700 a month can be a lot of money to pay. So sometimes it's easier to take the 30-year mortgage, have the flexibility and the peace of mind knowing that, hey, if I have a good month and we close maybe a lot of deals, you can make that extra principal payment versus handcuffing yourself to the higher payment, making sure that you do that every single month. So there's a lot of flexibility when it comes to making your payments. And there's also some other strategies where you can make bi-weekly payments. That ends up adding an extra payment in every year, which then also shrinks and shortens up the time that you've had your mortgage. So there's a lot of ways that you can look at how to finance a house. Again, this is the difference between a 30-year and a 15-year. The biggest savings is going to be the interest that's paid. I hope you can see the difference between how points work and sometimes just how small of a difference it makes. And that's why I stress so much in our videos, make sure that you're looking at your options. Don't get so focused and consumed about the interest rate, because you can see in these examples, right? On a 30-year, we're saving 40 something bucks. On a 15-year, we're saving 30 something bucks. Even if I showed you these payments without even showing you what the interest rate is, I guarantee you half of you wouldn't even know the difference between what the payments were. So that's why, to me, the interest rate, even though it's such a driving factor on how people decide on who they work with, I think it's secondary, because if you have a good option and you can look at other ways to structure your loan, to me, that is far more important than just asking your lender what the rate is and going with whoever gives you the lowest deal possible. So I hope this gives you a little more insight as to the difference between a 30-year mortgage and a 15-year mortgage. Again, here at Loan Depot, we've got options all the way down to a 10-year. There's a lot of options, different ways that we can structure your loan to help you guys meet your financial goals. And I think that's the number one thing your lender should be asking you. So if you guys have questions and you guys would like a custom analysis like this, send me an email. I'd be happy to talk to you, and we can throw one of these together for you and hopefully help you make the right decision with your mortgage in the future. And we can do this either on a purchase or a refinance. So we're here for you either way. Again, if you guys got questions, comment below. I'm here for you guys. Thanks for watching, and I'll see you on the next one.